I've been seeing a lot of comments like this lately of people considering using funds like Jepi and NUSI as an extension of their savings account and even their emergency fund. And I gotta say, I'm very sympathetic to the cause, and it's something I thought about doing a lot, but it does violate the most important rule of investing, which is never invest money that you can't afford to lose. So, by nature of this question, by taking your emergency fund, which needs to be there in the case of emergencies, and investing it to try and get a higher return, there's inherent risk involved with that. And that's why, for most people, they should have investments and they should have their emergency fund. Two separate things. But in this video, I do want to entertain the idea and see the kinds of risk involved with doing this and what paths you might have. Okay, so when it comes to investing your emergency fund into the market, the main thing is the risk of the investment. What's the probability that when you need the money in an emergency, it's going to be there, right? That's the risk involved, and then the reward is what's your compensation for that risk. So a regular savings account, right now they have an average APY of 0.04% per year. So this is the safest. If you put 10,000 bucks into a savings account in 5 years, it's still going to be there. In fact, with that kind of APY, in 5 years you're going to have $10,021. So it's extremely secure. It's always going to be there. It's usually FDIC insured, but the trade-off is you have no return. Although when you factor in inflation, which is roughly 2.5% per year, then after 5 years, if you have that same 10,000 bucks, if it isn't worth 11,315 bucks, you are not even keeping pace with inflation. And this is why people look for alternative investments, because they don't want their money to be decaying over time in a savings account. Here's a list of low risk investments, and we have things like a high yield savings account, CDs, treasury bills, so on and so on. So I want to take a look at a few of these and look at the risk and the potential reward. So let's take a look into some of these options. The first one is that high yield savings account. When it comes to the risk and having your money there when you need it, this is a savings account after all, so it's very low risk. When you need the money, it's going to be there. But the average APY is only about 0.6%. So 10,000 bucks in a high yield savings account over 5 years will leave you with a balance of 10,305 bucks. And that's still less than inflation. Remember, 10,000 bucks over 5 years with 2.5% inflation, you would need 11,315 just to keep pace with it. Another step up are government bonds. This is ticker GOVT, and it's US Treasury bonds, which are very secure. In fact, if we look at a chart versus the S&P 500, it's very flat, and the flatter the line, the more reliable and safe it is in this context. If you put your money in the market, which is the green line, we can see how it goes up and down pretty drastically. Long term, we all know the market is the best place to be, but when we're talking about an emergency fund, which you might need at any given time, the flatter the line, the safer it is, and the more likely the money's going to be there when you need it most. So treasury bonds are pretty safe, but they only have a yield of 1.85%. So if you put your $10,000 emergency fund into that, after 5 years, it'd be worth 10,969 bucks. And that is a lot better. That's almost keeping pace with inflation with very minimal levels of additional risk. And the next step up from this is putting your money into the equity markets in a fund like Jepi. So this allows your money to go up and down with the market. It does have a lower volatility, but it has a pretty high dividend yield of 7.3%. So taking into consideration just the dividend yield, if you put 10,000 bucks in this over 5 years, you would have a value of 14,390 bucks. So a lot more return. Now to see if investing your emergency fund into the market is worth it, now we have to look into the data to see what's the probability that your money is going to be there when you need it. On any given day, stocks have a 53% chance of rising and a 47% chance of falling. So day to day, that's your probability of having your money when you need it. And as we stretch it out to longer and longer time frames, the odds become more in your favor. So in a 3-month period, stocks rise 68% of the time and fall 32% of the time. And on a 12-month period, stocks rise 75% of the time and fall only 25% of the time. So in the context of an emergency fund, if you put it in the market throughout a 12-month period, 25% of the time it's going to be down and 75% of the time it's going to be positive. Here's some more data on market pullbacks. So a 5% or greater pullback occurs about every 7 months. A 10% or greater pullback occurs about every 2 years, and a 20% or greater pullback every 7 years. The average length of a bear market is 289 days, and the average length of a bull market is 973 days. I like this chart because in these green lines, these are the annual returns of the S&P 500. So we can see that most years the S&P 500 is positive, has positive returns. But these red dots are the intra-year declines. So for example, in 2010, the market went up 15.1%, but within that year, at some point, it was actually down 15.6%. So as a long-term investor, the market goes up, and that's why investing is such a great thing. But when it comes to an emergency fund and having access to your money at any given time, it can be a bit of a rocky road. This is another visualization of bear and bull markets. And again, the odds are in your favor. The market usually is going up. And lastly, this is taking a look at just the past 10 years and how the market behaved. So one of those years was down 4.4%. In two of those years, we were up only 2% or less. Three of the years, we were up more than 20%. And 4 out of the past 10 years were up between 12 and 19%. Now, luckily, we're talking about investing in a fund like Jepi, which is lower volatility than the general market. And Jepi has a beta of 0.52, so it only moves around half as much as the general market, which is going to help to smooth out some of those ups and downs. In fact, if we look at the chart and compare them directly, they move up and down together, but the amount they move, the volatility, is a lot less with Jepi, which is going to help you if you want to use it as an emergency fund. We can add in that government ETF just for the purposes of comparing risk levels, because the more bumpy the line is, the greater odds that when you need the money, the market might be down. US Treasury bills are a relatively safe investment. It doesn't move too much, and in comparison to that, the general market does move up and down quite a bit, and Jepi is close to the market, but because the beta is less, the price swings day to day are a lot less. So with the knowledge of risk in mind, things like within a 12-month period, stocks go up 75% of the time and they go down 25% of the time, you have to ask yourself, what is your risk tolerance for an emergency account? If you wanted to just always be there and be safe, then a regular savings account is the way to go, but your money is going to decay over time and not give you any kind of competitive return. US Treasury bills are just a little bit more risky than a savings account, but they give you much more return, almost enough to keep pace with inflation. When it comes to the equity market, we all know that long term that is the place to be, but short term, day to day, the swings can be pretty intense, and low beta funds like Jepi do help to smooth out the day to day fluctuations. But on short time frames, it is risky. You don't know if your money is going to fully be there. But of course, you are rewarded with the highest returns with over a 7% dividend yield. So let us know in the comments down below which path you would choose. Personally, I wouldn't go all in on Jepi. It's just too risky for me for an emergency fund, but I definitely wouldn't be opposed to putting at least some of my emergency fund into Jepi and maybe most of it into US Treasury bills, just so I don't lose a lot of my buying power to inflation over time. Because even though a savings account is quote unquote safe, you're essentially guaranteeing that every year you're going to lose 2.5% in this quote unquote investment. So there's risk in everything you do. The question is, how much risk do you want to take on? So let us know in the comments down below what your risk tolerance is. If you're still watching and enjoyed, give the video a like, subscribe to the channel. Also, you can support the channel on Patreon, link down below. You can also get access to exclusive content on the Patreon, so check that out. But regardless, I'll see you guys in the next one.